Hey everyone, hey investors. This is the Reckless Investor Show. This is Marquise, your host. Today, we're going to do a walkthrough of the Clear Picture Valuation and Gut Check Score. Today, we're going to look at Adobe. So what I do first, I still have my numbers from ADBE from the last video. But, let's look at it and fix it. So what I do, I go to stock analysis, and what I do is I pretty much just grab the numbers, make sure you get all of it, command, copy, and just paste, and just do that for the balance sheet. If I have some extra overflow, I just delete it. Here's the cash. And go all the way down. Copy. So since I have two of the same rows, just delete the rows. The ratio. So just copy and just repeat. Oop. So I don't have the, I can't log in because I don't have an account. I just use the website. So I could export to a Excel or CVS or CSV file, but I don't want to pay. Oops, I messed up. I did not get the years. That's better. So let's go here and paste. Ooh, why is that doing that? So sometimes when it does that, I like to do it on my phone. So I need the ratios. Sorry if you can't hear me. I'm trying to get it off on my phone. Clear picture. My phone worked for me. Ooh. There you go. I fixed it. Alright, so what you want to do, because you want the full year, not the current year, just delete the column. Delete this one because it's just annoying to have there. Same thing with, make sure 2021 is the most recent year, full year. And just go through if you want, tidy up, and get rid of this column. Why did I do that? I went to the wrong column. Thank you. And one last one. Alright, let's go this one. See, this is what I was talking about, I think, in my previous video. It will bring in the right, I could say, location, but I put in a one spot over. So what I just need to do is copy, paste. That's not good. So copy, paste, and edit. Go to G because G is 2016. Same thing here. So edit these. And there you go. Oh, forgot one. So it needs to be B. Make sure net income B12. B12 is not the right one. It's B15. That's better. Free cash flow 19. See, this is what I have to do every once in a while. Is just make sure everything's B17 is correct. B5. Yep. And yep. Alright, let's go check the score. So the revenue growth has been up 62%, almost 63, almost 64% of profit growth. Profit margin is 83. Why in the world is the gross margin so low? That's something I need to look into, is why their gross margin is so low. Net income is 75, net margin is 71, free cash flow is 71% on the dot. That's amazing. They do not know how to control the free cash flow though. They don't know how to manage it at all. And the margin or the yield is horrible. That's something you need to look at. Because remember, free cash flow is king. Without free cash flow, your company cannot grow. You cannot pay off debt. You can't do anything. If they're mismanaging their free cash flow, something's wrong. Management needs to look into why their free cash flow management skills, like you say, is wrong or bad. All right, let's move on. Free cash flow to debt or debt to free cash flow. They can pay all the debt off in pretty much less than a year. They're buying back about $21 million shares. So you're gaining back about 4.4% on your investment or your value of your share. Good return on invested capital. Return on equity is good. That's amazing. I like doing this first before I do the discount cash flow model. But speaking of that, let's check it out. Cash from operation, E6. Yep. Capital expenditures should be the same. Yep. Net income, E15. Yep. Excuse me. Sorry. Yep. Let's look at Adobe. Let's see where the forecast says. So the forecast is a high of $682 with a low of $454 and an average of $571. Okay. So they're expecting almost a 15% increase in Adobe sales. After that, 14%. Alright. So here's how I do it. That's simple right there. 1821 is right here. I just add an extra zero at the end. Yep. Ooh. Let me see the forecast again. They see a low of 454. Huh. Let me see if I can get to it. But for me, I get 239. This is the cash. This is the total debt. It needs to fall for me 35%. Almost 36%. Nope. It's not even it. 330. Nope. Wow, what? So that's the bulk. That's for me to get 7% return is 572. That's right above the average. Let's see, 8. Oh yeah, 7 to 8% return. But I want 12.5%. I'm greedy. But so it needs to fall 35%. So it is overvalued. Don't get me wrong. But okay, let's look at it. Current price is $372. The fair value is $239. The extra margin of safety is 65%. The acceptable buy price is $155.68. So in a sense, it needs to fall more than 50% for me to buy it. But here is everyone's favorite thing, the gut check score. Let's check it out. So they're down. They have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. They have 10 yeses. Okay, I'm pretty sure this is going to come up, but the percentage of shares is not a measurement of the gut check or the clear picture. It's just for me to see if I'm being diluted or I'm getting value in my share, or my holding, and by how much. So they have 3 no's, and that comes out to be 10. Look at that, 76.92%. So that's yeah. Mark it down if I can talk, and we get 10. 6, 14, ooh, and 1 p.m. Let's bring this down. And bring this down. Alright guys. That's how I do it. That's how I do my clear picture evaluation. That's my walkthrough. And take care, investors.